Welcome options traders. Hello everyone. I just wanted to post a video here to talk about the importance of using vertical spreads to roll to different strikes. And it's an important topic because you'll hear me talk about in this forum a lot that maybe it's time to roll your Amazon calls or roll these puts. We want to roll them up. We want to roll them down. And when you do that, you want to use vertical spreads. Unfortunately, a lot of new traders say, that's too complicated. I'm just going to enter them as separate trades. And there's a big risk in doing that. So let's find out why you want to use verticals to roll to different strikes. First of all, what does it mean to roll an option? Well, anytime we talk about rolling options, it's really an options trade that allows traders to change to different expirations and or strikes. So for example, let's say you want to change from the August to September expiration. Maybe your August is about to expire. And we don't want to wait for Monday for it to expire and then buy September's. We just want to change from August to September simultaneously, and we would do that with a simultaneous trade. We would sell our August call and buy the September. And that's actually a horizontal roll, which would be done by buying a calendar spread. But the idea is that it's just a simultaneous trade. It's one trade that takes care of both transactions. So in the business, we would say that you have rolled from August to September. Without a doubt, the most important and the most powerful of all of your rolls is a roll up for call options. Now there is a sister strategy that's a roll down for puts. I'm not going to talk about it here, mostly because what I advocate in the group here is long-term investing. That's where the real big money is. And there is a definite long-term upward bias to stocks. There's rarely a long-term downward bias, which is why we usually don't buy long-term puts. But we will buy long-term calls. So more often than not, we're going to be doing roll-ups with our long calls. So I'm just going to focus on that for the video. So let's say that you buy the $50 call for 6. And yes, you do have limited downside, certainly much less than if you had bought the shares for 50. We also get unlimited upside. So those are both benefits. We enjoy all of the gains of the stock trader, but with limited downside. But there are still risk problems. We'd like to protect our $6 that we put into the call. So let's take a look at the profit and loss diagram. Here's our $50 call purchased for 6. Once again, for those of you who do not understand profit and loss diagrams, there's a video right here in this forum entitled Profit and Loss Diagrams that will explain them to you. But anytime you have a long call, it's going to look like this hockey stick shaped graph, and you'll always get a bend right here at the strike. So this is our $50 call purchased for 6. I'd like to protect that $6 downside. So let's say that the stock makes a nice move up and I would like to roll from my 50 call to the 55 call. Now, first of all, why would I want to do that? My main motivation is that I'm going to receive a credit. There's another principle of options trading that says lower strike calls have to be worth more money than higher strikes. Because in this example, there's a bigger benefit in having the right to pay $50 for shares than $55. It's a lower price to pay for the shares. The market recognizes that and will always put a higher price on the $50 call relative to the 55, assuming the same expiration. So when I sell my 50 and I buy my 55, I'm going to get a credit. And because this is a $5 roll, moving up $5 in strikes, I'm normally going to shoot for a $4 credit. I'm not going to talk in this video why I do that. There's a good mathematical reason. I talk about it more in the Alpha Trader course. But let's just say I get this $4 credit. I initially paid $6. What happens to my cost basis now? Well, I now have a net cost of $2 on the $55 call. So I've shifted from the red to the yellow. And my main motivation is to reduce this maximum loss. I still have unlimited upside like I did before, but I've greatly reduced the maximum I can lose from 6 to 2. Is there a cost? Yes, there's this little tiny sliver right here. It's kind of hard to see in this video, but I'm actually sacrificing $1 of upside. But that's a good trade-off. I'm reducing my risk by 4 in exchange for sacrificing $1 of upside. Let's say the stock makes another big move and I roll for another $4 credit. What happens now? Well, I had a $2 cost basis. I received $4. Now I'm actually plus 2. I actually have a negative cost basis. My curve has shifted from below 0 to above. So let's clear off the graph here and take a look at my new position. The most interesting thing about this is that the entire graph sits above my zero line right here. Remember, when I first put the position on, any portion of my profit and loss diagram that sat below this zero line represented a loss. Well, now look at it. I can't lose no matter how low that stock price falls. I am guaranteed to get $2 back minimum on my $6 investment, but I still have the room for unlimited gains. And now I can enjoy the ride for the long-term gains without the fear of losses. So when I do those rolls, I always want to use a vertical spread. And a vertical spread, again, is just 2 orders in there, but it's done as a package deal. So on that first roll, I might sell that $50 call. Keep in mind that would be a closing order. And I would simultaneously buy the $55 call. That would be an opening trade. And we would say that is selling the 50-55 vertical spread. So all I have to do is go to my broker's platform and say sell the 50-55 vertical. And I'm going to simultaneously execute those 2 transactions. So here's what's going to happen in the end. Keep in mind I started out with a long $50 call. When I enter the sale of the 50-55 vertical spread, I'm going to put these 2 trades in simultaneously. It's a package deal. It's one ticket, but it's going to execute both of those trades. But notice that once it executes, the long 50 and the short 50 cancel. And in the end, I'm just left with a long $55 call, exactly what I wanted. Now, sometimes the new traders say, yeah, I kind of understand that, but it's really complicated. I just understand it better to enter them as 2 separate trades. And so what they'll do is they will do 2 separate trades to roll their options. For example, they might say, I'm going to turn around and sell my $50 call, wait for an execution. Okay, I got my confirmation. Now let me turn around, type up a new order, and buy the $55 call. And when I do that, yes, I have sold the 50 and I'm long the $55 call. It is the same outcome as using a vertical spread, but it took 2 separate trades. And the problem that most new traders fail to understand is that this entails execution risk. So what in the world is that? Well, let's say that you are going to place these 2 separate trades. And in your mind, you think that you're going to get a $4 credit. That's kind of where the current market is for selling the 50 and buying the 55. However, as Murphy's Law would have it, while you're typing up your order to sell your $50 call, the stock starts to fall a little bit. And it doesn't take much because we're usually going to roll when we're fairly good amount in the money. We've got some high deltas here. It's going to affect that price. And so I end up getting less money for my $50 call than I thought. And then I get the execution, which I have to wait for. Once that's done, I start typing up the order for the $55 call. And while that's happening, Murphy's Law strikes again, and the stock actually starts to rise. And so I end up paying a little bit more for the $55 call. So even though I had my expectations on this $4 credit, I end up with a credit of, let's say, $3.50. That's execution risk. And it happens because we get adverse stock price movements while we're setting up the individual trades. However, how can we eliminate the execution risk? If I use the vertical spread, which is a package deal, I put that blue box around it to just remind you that is going to be executed as one trade. And let's say that the stock price actually starts to rise. Well, it's not really a big deal. Yes, I'm going to pay more for that 55, but I'm also going to receive more for that 50. And that $4 credit that I initially saw is going to stay about the same. But now let's say instead that the stock price falls. Well, the bad news is I'm going to receive less for my $50 call, but the good news is I'm going to pay less for that 55. And that difference between them will still stay about $4. So the main reason that we use vertical spreads or any type of simultaneous trade to do rolls is that we reduce execution risk. So for all the new traders, or for all of you who have never been using vertical spreads, make sure you're using your vertical spreads and you're going to get much better, much more consistent fills on your rolls. If you'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and Strategy Lab at OptionsAtoZ.com. You're also invited to join us on the Facebook trading group Options A to Z.